Have you reset some of your expectations based on the Fed meeting this week?
Oh, we certainly have. Look, we're calling for earnings next year basically to be flat year on year with this year. And frankly, we were below consensus and continue to be below consensus for 2022 as well. And obviously, we slashed our price target. And it's one of these years that now, actually, Wednesday has ushered in the emotional phase of this bear market, which, frankly, every bear market does tend to have an emotional phase, simply because when you look at what the Fed chair said and the projections, and importantly, it's that unemployment number projected to be 4.4% next year, where the rate of change, there's never not been a recession following hard upon that kind of change. And all of that has caused the emotion to come into the markets and subsequently, of course, these types of revisions.
Julian, rising bond yields, higher commodity prices, these have been the two dominant factors that are impacting U.S. equity earnings. I'm wondering, the pace of equity earning downward revisions, are we comfortable with that? Is it going to accelerate over the next few months?
Well, it's actually less about the pace than the band of uncertainty. So if you look at estimates for next year, they range from 185 on the low end to 255 on the high end. That's absolutely unprecedented, and it speaks to the uncertainty in all asset markets. And again, frankly, when you think about it and you see the screen, everything is red today, and that tells you that uncertainty really is approaching those critical levels.
Well, Julian, on the earnings side, we have been having the conversation for some time now that there is inflationary pressure, higher input costs. It's going to weigh on corporate margins. They aren't going to be able to pass it on. And yet it's been actually okay to this point. Why would things change now as we're seeing some of those inflationary pressures winding down a bit? Why is it now ultimately that those margin pressures are really going to come through? Is it just an inability on the demand side to be passing those costs on to the end customer?
So, Kaylee, if you think about this year, it's been very unusual in that the sentiment data on the consumer side has been, subdued, worse than subdued the entire year because of the consumers sort of internalizing the idea of inflation, but yet the spend has been, really quite reasonable when you think about it. That, in our view, is about to change because, frankly, conditions are really warranting a little bit more of a button-down type of attitude. And to that point, that's where the attack on margins, the attack on volumes comes in, and again the risk in markets. But the story is that this is part of the Fed's calculus. The question being, though, are we in the process of potentially breaking something?
Well, and Julian, to that point, let's begin where we started. Let's end where we started, rather, where you said this marks the emotional phase of this bear market. What are we currently pricing in? How long will the recession be? How deep? The idea of a soft landing, or at least a shallow recession, is that kind of off the table?
It's not entirely off the table. What we think the Fed may have been missing, and it's our view, that inflation is actually starting to come in. Whether you measure it by break-evens, there's a disconnect between the fact that embedded inflation expectations simply aren't there. And in this respect, this is not the 1970s. And in our view, we think the data over the next couple of months will reflect that. Is it going to happen quick enough for the Fed not to do 50 or 75 on November 2nd? Possibly not. But frankly, we think that type of reckoning is out there in the future. And that's the kind of psychology that could forestall or make any recession in 2023 a more shallow event.